got our buddies from Now and Associates, Russ Morgan, Justin Kraft in studio. We're talking all things money. So tell me exactly what we're working on over here. We got the 401k thing.
Yeah, so one of the things that we covered in the workshop on Saturday was talking about, again, our dollars have to reside somewhere, Michael.
Right.
And when we put them in any sort of savings or investing vehicle, they're going to reside in one of three accounts. All right? They're going to reside either in a taxable account, a tax-deferred account, or a tax-free account.
Well, there's a fourth.
Okay.
In my case, it's just a tax account, as in the U.S. Treasury has my money. Just saying.
So one of the things that we asked all the attendees is if you could choose, where would you want your money to reside? Taxable, tax-deferred, or tax-free? Well, again, the resounding response was, well, we'd want it to be tax-free.
Sure.
And so we went through and we actually looked at which accounts are taxable, which accounts are tax-deferred, and which accounts are tax-free. Well, 401ks is one of the number one places people invest money on a monthly basis. I think there's like $19 trillion in qualified plans. And we talked about where this money was created through the Revenue Act of 1978, 1979, which, again, that's when the government accurately labeled things. They said this is going to be a revenue-generating activity for us. We're going to create this plan for you. Unfortunately, most people have thought it was going to be a revenue-generating activity for them, and so they've put large amounts of money in it. And so we talked about, well, what type of accounts are these? These accounts are tax-deferred accounts. And for the average person, they don't really understand what that means. They think tax-deferred. And by the way, I had an accountant send one of my clients an email this past week and said, we ought to take advantage of these different IRAs this year so that way you can save taxes. Now, Justin, is saving taxes, is that an accurate statement when we put money into IRAs or 401ks?
Is it an accurate statement? And the answer is no. You are not only deferring the tax, you're not saving the tax. You're deferring it. But what you're also doing, Russ, is you're deferring the calculation as well.
What's that mean?
Here's what that means. If we put money in today, Michael, and we're in a 20% tax bracket, that means what he was talking about is we're saving 20 cents. However, what they're not telling you is if you peel the onion back, all you're doing is deferring that 20 cents for the privilege of paying it back at a later date. Right. And if your tax bracket is higher, then what has that done to the money you've saved? If you got a deduction at 20 cents and you had to pay 25 cents back, did you win the game? No. Who won the game? Uncle Sam.
Right.
And we just encourage people to think about that and understand that. Now, is that true in every situation? And the answer is no.
But give an example. I think that maybe because we say that and we put lip service to that, and there's a lot of people, again, the reason they're putting money in these plans, they may or may not be good for them. I'm not giving that information today, but I want them to know that they've got to think deeper and think through it. So can you give Michael an example that maybe everybody could resonate with? Okay, how does this, I don't know if I'm deferring a tax, what is the cost going to be? Maybe an analogy or something that maybe would resonate.
I can't think of one. I'm kidding. He put me on the spot, Michael. The first thing that comes to mind for me, Russ, really is we talk about Nelson Nash a lot, Michael. Sure. And Nelson Nash has been a mentor for Russ and I. He's now an 84-year-old economist that wrote the original book over 20 years ago, Becoming Your Own Banker. That is kind of the workbook that talks about this process and setting up a strategy where you can build wealth and save your money and have control of it and do it in a tax advantage way. So one day we were visiting, and he asked me a question, and I'll just share it with you because it really resonated with me. He said, Justin, you and I are going to go into business together. So, Michael, let's assume you and I are going to go into business together. Here's the deal. I want you to put up all the money. I want you to take all the risk of the business. I want you to do all the labor. I want you to manage it or pay someone to manage it each and every day. And then we're going to get out 20 years. I'm going to see how successful your business is, and then I'll tell you what percent partner I'll be with you. You want to take that deal?
Absolutely not.
Nobody would, but I want the listeners to think about that. When Russ says peel the onion back further and let's think through our choices, that is exactly what we're doing when we make a contribution into a qualified plan.
Right.
You're putting up all the money, you're taking all the risk, you're having to manage it or pay someone to manage it, and then at the end of the day, you have no idea what tax bracket you're going to be in
Right.
when you take that money out. You have no idea what the government is going to do with taxes. So essentially, you're making a deal, and people across the country are standing in line to make that deal that you just said no one would do, that
Right.
you wouldn't do and no
Sure.
one else would do. And that's what we're doing. So all we're asking people to do is think through that and understand the old parable that would you rather pay tax on the seed or the harvest?
Right.
If we have $1 today and we think taxes are going to go up in the future, then wouldn't we rather pay the tax today when we're in a lower tax bracket than we would down the road in a higher tax bracket? It only makes common sense, right?
Mm-hmm.
But people aren't talking about that. And so those are the ideas that we try to bring up in our workshops. There's videos that are talking about this on our website, fireyourbankertoday.com. If you've got questions, if you've got any interest in all in what we're talking about, I encourage you to go there and educate yourself and see for yourself what it means to peel the onion back further on these retirement plans.
What do you think? And I'll toss this out to either one of you, but what do you think is the biggest misconception about what we're doing here? Because every time you guys come on, I'm going to get the email. I'm going to get that email, and it's basically the snake oil email. So, and we know that it's not. And there's people in this book across this building that are practitioners of this. You've got a long, long, long list of success. A lot of folks you brought up here as well.
Yeah.
And as you point out, it's not a matter of placing money in a whole life policy versus investing in term and invest the difference. But people simply do not seem to understand. And y'all been on the air with me long enough to know people hear what they're going to hear. Sure. They hear it out of me. They hear it out of Steve. Can't tell you how many times I get an email where somebody will chastise me for saying something I didn't even say. So with that said, what do you think, despite the fact you guys have been coming on here for a year and explaining this rather in depth, what do you think is still one of the biggest misconceptions the average person has?
Misconception, I may let you address completely that concept, but Michael, I think the biggest reservation most people have is that not everybody's doing it. We're such a society that we care more about what other people think about us than what we care about is right.
Right.
And, Nelson, I've heard him say several times that, people buy things with money that for things they can't afford with money that they don't have to impress people that they don't know who could care less. And I think that's the way people are, is that they think, well, if I do something that's against the grain, if I go against mainstream, then other people are going to think things ill will about me, or they're going to think that I'm doing it weirdly. So I'm not, I just don't even want to get involved in that. And that's what my personal opinion. And hey, look, we talk about Dave Ramsey. I think he's got one of the greatest bumper stickers and slogans out there when he talks about if debt is normal, be weird.
Right.
I'm all about. Nelson, he says in his book, and I've heard him say it a time or two, that this goes against conventional thinking, and that's not a negative. That's
right.
A plus.
Years ago, it was Jay Rockefeller that said it, and I'm paraphrasing, when asked about a certain stock that was very, very, very popular, and an investor made a comment to him, or rather a broker made a comment to him, that everybody is jumping on board this stock because it's about to go. It's about to run. And his response to that was, once everybody else jumps on board, it's already done what it's going to do.
That's right.
Well, how many have heard our parents say, well, if everybody else was going to jump off the bridge, would you do it too?
Right.
So just because everybody else is doing it doesn't make it right. And so I think for us is what most people aren't doing, they're not educating themselves. They're sticking their head in the sand. They're sticking the talent in the sand, and they're not even looking into, is this the best situation? Because what we're talking about, these 401ks, we went through in the workshop and talked about when they were created and were they a good event at that time.
Right.
Well, remember, tax rates were a lot higher in the early 80s than they are today. There was a lot less people investing in the stock market then. Times have changed. Have you changed your process?